Okay, and we're live. Hello, everybody out there in the digital world. We're happy to have you join us. We were going to be starting in about 5 minutes. We figure we would go live so that we could give you an opportunity to start checking the features and the functions of the Zoom webinar program. Although let's face it, everybody should be a Zoom expert at this point with all these Zoom meetings going on. This is my, I believe, third Zoom meeting of the week, and I'm sure many of you out there have already had just as many, if not more. Some folks are having multiple Zoom meetings every day. So get settled. We are going to kick off right at noon, and we have a great presentation for you today. To the San Diego chapter of the CCIM Institute's August 19th Lunch and Learn. We are delighted for you to join us on this beautiful and warm San Diego afternoon. I'm Doug Tabor, VP of the CCIM San Diego. You may also know me as a rental housing realtor with KW Commercial's La Mesa office and Keller Williams. My co-host today is my fellow board member, Ms. Paris Moe. Paris is a sustainability coordinator at Verdani Partners and recent graduate of the USD MBA and Masters of Real Estate program. How are you today, Paris?
I'm doing well. Looking forward to the presentation.
Wonderful. And we are grateful for your participation this morning. Okay. A few housekeeping items. You are in listen-only mode. As I was explaining earlier, we can't see you, but you are welcome to chat with each other using the chat box, which it appears some of you have already discovered. Questions. We love these events because they have an opportunity to ask a lot of questions. So please use the Q&A box to submit questions. At that point, Paris will take those questions and then she will relay them to the speaker out loud so everybody hears it. But please use the Q&A box for your questions. Use the chat box so you can have a discussion with each other. This webinar will be recorded, and like I said earlier, it will be made available to you after the event. And also you can use the Zoom reactions at the bottom of your screen to also express yourself in ways only a Zoom meeting will allow you to do. The agenda is pretty simple today. We have a speaker that's going to be starting here shortly, and we are going to allow for questions during the event. We have a hard stop at 12:55. The speaker has another engagement, probably another Zoom meeting, and at that time we will conclude. A little bit about CCIM. For those of you who were wondering, CCIM stands for Certified Commercial Investment Member. Our membership is made up of commercial real estate professionals from across the globe, literally around the world. The CCIM lapel pin denotes that the wearer has completed advanced coursework in real estate economics and investing and demonstrated proven industry experience. Sorry, I'm a little behind on my slides here. As a local chapter, we focus on educating and networking events like this one that promote excellence, competency, and collaboration. You can find out more about the CCIM network on our website, CCIM San Diego, as well as our new LinkedIn page, which is on LinkedIn. Certainly reach out and follow that page. Now, if I may, I would like to thank our sponsors for this year, especially in 2020. We are very grateful for those companies that continue to sponsor CCIM San Diego. And that list includes our platinum sponsors, which are Chase Commercial Lending, Hex Sahlberg, Marcus & Millichap, Marsh McLennan, Procopio, and Savills. Our gold sponsors are CoStar, Exeter 1031 Exchange Services, Langford & Associates, Pacific Medical Buildings, Slat Capital, SCS Engineers, Global Hotel Network, Voight Real Estate Services, South Coast Commercial, Pacific Western Bank, and the Port of San Diego. We thank you for your continued support, especially in 2020. Okay. Now, we're going to kick off our first poll. You kind of know who we are. I'm about to introduce our speaker, but what we like to do is find out a little bit about who you are in the audience. So Ellen, if you would, please go ahead and start our first poll and we will get an idea of who we're with. So please take a moment to complete the poll and let us know who you are, and that really helps us out going forward. All right, it looks like we have a number of owner investors, of course, brokers, property managers, developers. All right, so the winner in this group, as usual, is our owner investor category of 43%, next in line with our brokers. So wonderful. Well, welcome. We're happy to have all of you here and are grateful for you to spend the time with us today. And now it gives me great pleasure to introduce our speaker this morning, Mr. Alan Nevin, a local luminary in our real estate market. Alan is an economist, a demographer, and a futurist. His consulting practice concentrates on providing individuals and real estate investors with cogent advice on real estate investment strategies. Alan's book, The Great Divide, analyzes the demographic patterns that shape the world in the United States in particular. I have read it. I have my copy here today, and I highly recommend this to my investor clients. So please give a warm welcome at your homes for Mr. Alan Nevin. Alan?
Thank you, Doug. I like the word luminary. I'm going to put that on my CV.
I added that one for you, Alan.
Okay, yeah, that's terrific. Paris, why don't you move into the slides? Today, I'm going to chat about COVID and the economy and, of course, real estate. So let's start off talking about COVID. Paris, the first slide basically looks at COVID in San Diego. And it's a sort of a sad slide because it shows that the vast majority of the deaths from COVID are older folks. And if you look at the yellow line, that's the percent of the population that they are. So they're a very small part of the population, but account for a large part of the deaths. I want to move on to the next one because that will show you the numbers far more clearly. As of last week, we had 608 deaths, and the reality is that 87% of them were folks over age 60. Fortunately, I know this entire audience is young people, so you don't have to worry about it. But it is the reality. Next, please. Now, one of the interesting things is that San Diego has had a much better record in terms of COVID. I can't tell you why we have a better record. It's just that we have about half of the deaths that the rest of the United States has. And California is also much better. So we're doing fine and we're getting better. And you'll see in the next couple of weeks, as more things open up, that we're opening up for business. Next, please. Within the world, we stand number 5. There is a small problem to the extent that we know that the number is coming out of Spain and Italy and China and Mexico may not be entirely accurate, may be somewhat understated, but the reality is that we're sort of right in the middle of the pack. The column on the far right is really fascinating. In Canada, 81% of all of their deaths are in nursing homes. We're at 41%, which is sort of right in the middle. It's also interesting to note that virtually 70% of all of the deaths from COVID have been in these 12 countries. And there are about 190 countries in the world. So it's a very, very unusual set of numbers. And this has been fairly constant for the last 90 days. Let's go to the next one. When we look at New York, New Jersey, which has a little over 18 million people, their number of deaths per million is about 7 times what it is in Southern California. And it really has to do with densification. There are in excess of 500 million square feet of 100 of square feet of office space in Manhattan, and even in downtown San Francisco, you only have 75 million. So it's a problem of density and also residential density. Let's look at the next. Now let's look at the economy. In April, which was the first month where we tabulated the impact of COVID, we jumped to an unemployment rate of 14.7%. Gradually, we're coming down. And in July, we were down to 10.8. And as I like to point out, as being an optimist, I like to look at the employment rate. And our employment rate is 89.2%, which is not brilliant, but it's not that horrible. Let's look at the next. One of the things I look at every single week is the initial unemployment claims to see how many people are being laid off. Since the worst week, which was March 28th, we have had an 86% decline in initial unemployment claims. And that's very, very positive news for the American economy. Let's look at the next. What we find, if we're just looking at San Diego now, we see that virtually half of all of the job losses in this county have been in leisure and hospitality. And when you look at the other 6 major job categories, you can see that March and April, they laid out a lot, but nowhere near leisure and hospitality. And then May and June have improved very, very dramatically. And obviously, I don't have July's numbers yet, but in the next couple of weeks I will. And I'm betting that it even shows a better situation. The reality is on leisure and hospitality is that it is slowly coming back. You can see where the losses in March and April were horrendous, but we had a pickup in jobs in May and June. The hotel business near the coast is doing very, very well. We're seeing sellouts every weekend along the coast. The big hurt, unfortunately, is the convention business downtown, because the 1,200 homeless living there don't really participate in the economy. And the big hotels, the Marriott, the Hyatt, the Omni, they're hurting. They're just now starting to reopen and trying to attract the summer tourism business, because the great news is that we have more than 25 million people within a 1 day's ride, actually within a 3-hour ride of San Diego, and they all love coming to the beach here. So I see us having a much better summer when we look ultimately at the July and August numbers. Next, please. One of the interesting facts that the Department of Labor Statistics publishes is unemployment rate by educational attainment. And if you look at that, what you see rather quickly is that if you have a college degree, the unemployment rate is below 7%, which is very positive. and has been a very good thing for the real estate market and other sectors of the population that rely on retail sales. On the next slide, we also note that when you look at unemployment rate by marital status, married men whose spouses live with them, the unemployment rate is 6.2%, which is amazingly good. And it also means most often that there is dual incomes in the households. In this county, 1.6 is the average number of jobs per household. So one of the things that people haven't been tracking, when you look at a household where the average is 1.6 and one loses the job, it doesn't mean that you're instantly destitute, because there's still one safety net in the household. And it's one of the reasons why in this community, things haven't been nearly as bad as they are in a lot of other markets in this country. Let's look at the next. Time to go into real estate. This is a wonderful table. The month of July was the best month we've had all year. The number of closings were 3,400. And on the next slide, you can see that this year was even better than last year. And when we look at the next slide, take a look at this because it's really fascinating. You basically have a market where realtors are achieving close to 100% of the asking price, and a significant number of the closings are at above the listing price. In the same vein, a significant number, 25 or 30%, have had offers over the listing price. The days on market has dropped precipitously. It says 28 for detached, 26 for attached. On the lower price ranges, it's much better than that. The scary part is the months of inventory. We're down to 1.3 on detached, 1.7 on attached. I can say that around most of the United States, 4 to 6 months of supply is normal. Our problem here, and it's a tough problem for the realtors, they don't have anything to sell. And what's happening is people don't want to let open houses coming, nor do they want the typical realtor caravan coming their way. So what we're finding now is that a very large percentage of the offers are made before the person ever sees the house. So business has really been good, and it would really be nice if we get more people to list their homes. But this part of the business is doing very, very well. Let's go to the next. When we look at the price ranges, this is important because what we're seeing is that business is really great in all the price ranges. The only weak spot, and it's only a problem of inventory, is single family detached under $500,000. There's just not enough units on the market to satisfy the clientele. But overall, when you think that the first 7 months of this year, that we sold more than 4,000 homes for over $1 million, that sort of tells you that this isn't exactly a depressed economy. Let's go on from here. Let's talk a little bit about commercial. Now, the reality is that you're all in commercial, and I'm not going to do a tutorial on that. I'm just going to make a few comments on each of the 4 big parts of the commercial world. Apartments, I'm absolutely delighted when I talk to my clients in the business, and they all tell me that they're collecting in excess of 90% of rents. And the what was supposed to be rent strikes hasn't happened. Now, rents are not going up, but they're not going down either. And the apartments are staying full. So that world's the only part that I see that's hurting at the moment is that apartment projects are not selling as fast as they should. And I don't understand that, because with interest rates the way they are, I would think that the turnover of apartment business would be absolutely booming. And the opportunities for renovation are so outstanding in this county that I would think investors would be jumping up and down just to get their hands on the apartments. Office market, that seems to be the big hurt in concept, yet it really hasn't been. We certainly recognize that with everybody working at home, the offices are fairly empty. But the reality is that with any luck, in the next few months, things will return to more normalcy. And the good news is that we're not overbuilding in office space. So there are some markets that have an enormous amount of construction in office space. We don't. So we will remain full. I suspect that what we will see over the next couple of years is reconfigure of office space, and it'll just go on. But we're doing okay. Retail, interesting. This is the area that I think will get the most attention and the most study over the next few years. At the regional level, we see enormous changes taking place. Obviously, Horton Plaza is not a bad example, where they're converting it into what they say is going to be 3,000 to 4,000 office jobs, and they'll also have some retail there. And when you look at what's happened to UTC, for instance, where Greystar has added a 300-unit, a beautiful high-rise apartment building, and there'll be a lot more reconfiguration of regional office centers. The shops at Carlsbad, which is now owned by Brookfield, will have a massive renovation ongoing over the next few years. And there's also, obviously, in North County Fair, with Nordstrom saying goodbye, there are going to be some major changes there as well. So on the regional side, a lot of changes. On the Vons, Ralph's type of centers, they will continue to do extremely well because they tend to have national anchors, Rite Aid, CVS, and their occupancies are staying fine. And a lot of their stores are open again, and their barber shops may have their chairs outside, but they are doing business. And the takeout business from restaurants has been surprisingly good all around the county. So the retail business is okay. Now, we have had an amazing amount of strength in retailing. Our vacancy rate has been constant at about 95, 96% for years now. And the result is that our retail overall is really strong and will remain that way. Now, industrial is today's hot button. We have about a couple of 100 million square feet of industrial space and the lowest vacancy rate in memory. I've been here 30 some years. I can't ever recall a situation where industrial vacancy rates were so low. And we don't have much land for industrial, so we don't have a lot of it going up, but we see the great strength in that market. And of course, when you start looking at firms like Amazon, Amazon has just taken down 500,000 square feet in Poway, and they're getting ready to break ground on 2.8 million square feet down on Otay. And when Amazon opens, there will be dozens of companies that feed into Amazon that are going to want space down there as well. So the industrial market here, I think, has enduring strength, and that makes me feel real good. What's on the next slide, Paris? Well, the second half of the year. I think you just went past it. There we go. Okay, I'm saying the second half of the year is going to be dynamic. Americans love to spend money. The big thing is that 40% of retail spending is between Thanksgiving and Christmas. And we're really talking about another several months before the Thanksgiving holidays. So I suspect that the pocketbooks will get very loose starting in the next couple of months. The major home builders, it's really fascinating. The last couple of months have been the best months for new home sales in about a year. When COVID first hit, they sort of died, but now the average tract is doing about one sale a week, which is a terrific thing. That's a nice pace. And our only problem is we don't have enough inventory. And we need to break ground on a large number of sale homes in order to do closings by the end of the year, which is what the national home builders have to do to meet their goals. So you're going to see a rash of new home construction coming up, and the sales will be there to greet them as the homes get completed. Car dealers making great deals. We had 6 years in a row where we sold 17 million cars in the United States. This year, it'll probably go down to 13 to 14 million. But one of the big problems is, particularly in used cars, is the inventory. We typically sell about 40 million used cars a year, and the dealers like to have a 2-month inventory, and they're down to a 1-month inventory. So they're really hurting for product. Now that the Japanese and Korean and German plants are back in business, we'll start seeing the new car inventory moving in, and that will help the situation and bring in more used cars in the trade-ins. The jobs in retailing, restaurants, and bars, if you go down to Little Italy now and see all the people eating in the middle of the street, it's a good thing to see. And it's nice to see Americans going out again. And dining out and recreation, maybe gyms won't be allowed to open, but almost everybody else will. And hospitals, which had basically been closed down because they couldn't do elective surgery when they had COVID, we're seeing now that COVID is declining fairly rapidly in terms of hospital admissions. And therefore, the elective surgeries are back in business. The facelifts and the hip replacements are going full bore now. And the residential realtors will be overwhelmed with folks who want to buy, and they are right now. So overall, I know it's fashionable to be negative, but I prefer to be optimistic because I really believe what I'm saying. Doug, go to it.
Well, Alan, and that's what I believe we all love about you, is that you're optimist with the numbers to back it up. So thank you for that presentation. We're going to open it up for questions, but before we do, we have another audience poll that we would like to submit. And Ellen, if you can put the next audience poll up that we'd like to engage the audience with. And the question on this one is, which property types will see the greatest rise in value or are you most inclined to invest in during 2020 and 2021? So we have retail, office, multifamily, single family, industrial, and hospitality. So which property type, asset class does our audience feel is the best investment? Well, you can see those numbers. Those are right in line with San Diego. And I didn't create this question, but being a multifamily broker, I'm delighted to see that multifamily is at 64%. Of course, single family still very strong at 17%. However, industrial at 19% was right in there. Alan, what are your thoughts on the results of the poll?
I understand it. And the reality is that most of the folks in your audience today are probably involved in multifamily rather than the other parts of the economy. You know, there are just not that many investor owners in retailing and hospitality.
Oh yeah, you're right. And you even mentioned it earlier. Multi-housing news has said that we're at 90% collections for multifamily. We've been that way since March. It never really was a dip. I know a lot of investors were sitting on the sidelines waiting for that great crash in values, but it never happened. So Alan, as we move into questions, we have a whole list of questions, and Ellen's gonna just open it up so we're all on the screen here. But what I wanted to do to kick off before we move into the questions from the audience is I have a statistic from your book here, and I wanted to ask you about this statistic and find out if it's changed because it's along the lines of home ownership and especially residential. And the statistic is the U.S. average of home ownership was 64% in the 1980 census and the same in 2010. And of course, being in California, this is a hot topic. A state that forever bemoans its unaffordability of housing had 55% ownership in 1980 and the same in 2010. Now, at the writing of your book, nothing has changed. But now fast forward to 2020. Where do we stand on that statistic? Do you know?
Absolutely nothing has changed. You know, we in San Diego, we have had 55% ownership for 40 years. It is what it is.
Wow, interesting. You get a different perspective from the media on a daily basis.
Well, it would be nice to be higher, just not going to happen.
So folks, if you're out there in the audience and you have questions for Alan, now is your opportunity. We still have about 25 minutes in order to answer those questions. But also, Paris, if you want to start asking some of the questions that we had submitted during the registration process for Alan, let's start with those.
Yes, thank you, Doug, for giving me the floor. Alan, thank you for sharing your take on the latest data on COVID, the economy, and real estate market. We've received a good amount of questions from attendees at registration, and we've broken them down according to the three aspects you just covered, and we'll go through them in the order of the presentation. So let's tackle questions related to the effects of COVID first. Alan, what will commercial real estate recovery look like after an effective COVID-19 vaccine becomes available?
I don't see much of a change. I really don't. I just think it's business as usual.
Sounds like a hopeful trajectory. And the second question is, are owners and property management at any increased risk when turning over a property to a new tenant due to COVID-19? What are some of the expected risks?
Would you say that again, Paris?
Yeah, sure. So are owners or property management at any increased risk when turning over a property to a new tenant due to COVID-19? What are the expected risks?
The answer is I see a lot of posturing, but I don't see much of a change. I don't see rents declining dramatically in terms of any of the four major categories. There doesn't seem to be much talk of that. Now, obviously, right now, there are some pennies being handed out in terms of free rents, reduced rent, but I don't see the long-term rents declining.
Thank you for that comment. So the question on the economy we received is on the potential passing of the split roll tax in California. So Alan, how would you adjust your recovery timing frame forecast for the California market if the split roll tax was to pass?
Well, I had really expected a V recovery, and it's turning into a U. And it's not because I thought there would be a vaccine, because I realized that's a way down the road. But we seem to have had a second wind in COVID that has caused the economy to move from a V into a U. So I see that the fourth quarter is really where there's going to be amazing increase in retail volume and other sales.
Thank you. So we'll all be keeping our eye on the fourth quarter now. So finally, let's move on to the more real estate specific questions. Do you see a downward trend in multifamily assets given the various level of eviction protection enforced by state and local governments?
It's interesting. Each government entity seems to have a different tact, and I don't think there's one story. There's not one size fits all. I think every single government body is doing something else with regard to whether it's eviction or rent control or some other mechanism where they're interfering in free enterprise. And I don't see any change that occurring there, especially in the city of San Diego.
Would you caution any of the investors who are eager to get into multifamily assets market? Do you have any advice to them?
I'm sorry, I don't have anything to add to that. No.
Yeah. Let's move on. So how much of the retail bounce back will happen in physical stores? And do you think the bounce back will be significant enough to allow shopping malls or even big boxes to have a comeback in terms of vacancy and value?
Well, in non-food stores, the comeback will be very slow. In other words, you have stores like Walmart and Target, which have a major food component, and therefore they're doing just fine. Not to mention Costco, which is doing brilliantly. But the non-food retailers are still going to see a fairly slow route back because people have learned how to shop online. If you go into, say, the Nordstroms at UTC, you see there's a fairly large amount of space where people have ordered online and can just come in and pick up what they've ordered. Now, the problem with that, and this is a uniform problem in the non-food sector, is that the stores depend on people picking up more than one item. So instead of being tempted to pick up a multitude of items, if you just come in and pick up what you bought online, it doesn't help retailing. And that's why so many of the major retailers are doing so poorly or have already filed Chapter 11.
Thank you. Following up on that response, what collateral damages can we expect within the retail apparel industry, such as to large tenants like Nordstrom?
It's sort of interesting. The retail, let's call it apparel related, and let's take it what it is. It's the women shopping, because they are at a minimum 75% of clothing and apparel and accessories. The days of not unlimited spending, but shopping as a hobby will phase down. And I'm reading that the fashion industry, for instance, which is an enormous industry, is really pulling back dramatically. So rather than having 3 or 4 new showings a year on the runways, they're going to have maybe 2 and sometimes 1, and they're not going to introduce as many new lines as they have traditionally. So it's really a major change in the way retailing is being done.
Thank you, Alan. So we have now received a few live questions from our audience as well. In respect of time, should we get to the live question, Doug?
Yes, let's go with the live questions.
Great. All right. So Alan, how much of a factor do you think interest rates will play in any recovery continuation
I'm sorry.
real estate trends?
Let me ask, am I able to see that on the screen?
You got to click on the questions, the Q&A
You should.
box.
So the question I was reading is, the latest submission. How much of a factor do you think interest rates will play in any recovery / continuation of real estate trends going forward? And can you qualify that given we are headed to a presidential election in the next 80 days?
Oh, I think the next few months are going to be very exciting. It really has a lot more to do with local government than it does the national, because of the types of government that are in charge of multiple levels. So you have the government of California trying to take over some functions of local government, and of course the national trying to take over functions of local as well as state. So until the election at the national level takes place in November, I think there's just going to be a lot of noise, but not much action. And hopefully we'll still have a post office.
Yeah, highly interesting. The future is definitely very unpredictable at the moment. So the next question asks, what do you see in terms of any new push to added additional rent controls in San Diego?
We went to a vote on that several years ago, and the populace turned it down very dramatically. I don't think San Diegans like rent control. Now, once again, we're in a situation where just a tad over half of the people own their own home. So you're talking about renters having a huge impact, except that owners vote a lot more than renters do. So rent control typically has not been and probably won't be a major factor in the votes in November.
Alan, to chime in on that, what are your thoughts on Proposition 21, which everybody should vote no on, by the way, which is another attempt by the AIDS Foundation of Los Angeles to do away with the Costa-Hawkins Act. They came at it with Prop 10, 2018, and now the new version, Prop 10 2.0, is essentially Prop 21, which will include single-family rentals to some extent.
They swear that it won't, but the reality is it probably will. So the answer is it's a terrible bill, and certainly doesn't do anything except line the coffers of the government budgets. And yeah, it'll bring in a lot more money, but very few folks, very few elected officials understand the ramifications of what it means for commercial properties.
Following up on that question of political propositions, Alan, what is your read on the Proposition 15, Schools First, commercial real estate legislation on the ballot in November?
I'm hoping it goes nowhere.
What if it was to pass? Do you see any potential impact that we need to be cautious of?
The answer is it's a mathematical calculation, and it will have an impact. It'll have an impact on what people are willing to pay for rent. It'll have an impact on income from folks who hold property, and it will have an impact on cash flow. Most certainly, if you're in a situation where you own an office building and it's a gross rent where you have to then eat the increase in their taxes, that's not a good thing, because reducing cash flow is just not a good idea, period.
Let's hope that your projection comes true. And so are there any new risks or liability to owners and investors renting to tenants due to COVID? Any added comments on that? I know we touched upon that.
No, I don't think so.
Do you see any impact to the commercial real estate markets if further government stimulus fails to materialize?
I'm generally wary of government stimuluses. They tend to come back to bite you. So, although I must admit, the payroll protection plan was a bonanza, as was the $600 a week. But we've seen that now go away. And I think that what you will begin to see is that the unemployment rate will start going down, because a lot of folks who were enjoying that bonus prize will now have to go back to work. And I will tell you that the Department of Labor says that there are 6 million jobs that are not being filled, that are in their data banks. And by the way, 10% of those are in California.
Why work if you're making $2,400 a month?
Yeah, exactly.
Hey, Alan, to add on that a little bit, on one of your previous slides, you talked about San Diego, and you were pointing out that there were obviously there's certain areas that are affected where unemployment is high, but could you maybe expand on the fact that, one thing that we have here is a wonderfully diverse economy. I think something like you, in a previous webinar, you talked about 51% of our jobs are basic jobs, which means they're not support jobs. They bring money in from other communities. Do you feel that that might be why we're so strong as far as, COVID and not really affecting us as it has maybe in other areas?
Well, the reality is, other than leisure and hospitality, we're in pretty good shape. One of the things that people sort of forget is that the unemployment rate excludes the military. So we have, I think, 110,000 people in uniform who are 100% employed who don't show up in the unemployment statistics. So if you put them back into the mix, it drops the unemployment rate a 0.5 to 0.75%. So yes, we have an amazing diversity. And the other part of it is that a large part of our manufacturing and biotech and software relates to federal contracts, and those are not going away. So yeah, we have a very large safety net here.
So it would be safe to say that people didn't get laid off as much as they just went home to work out of the house.
I think that's very true, including me.
Yeah. Okay, Paris, do we have some other questions?
Yes, we have a question on the residential real estate. So Ellen, what do you think, why do you think inventory for residential real estate in San Diego is so dangerously low, bringing bidding wars, and when most buyers don't want to participate in auction with 10 or more offers for a single property?
Well, I guess, as I stated earlier, it's a matter of they don't want people in the house, but they want to sell. And the follow-up question is this: if they're selling, where are they going? So if the inventory is as small as it is, then the question is, why are they selling? And what we also know, of course, it's not desperation, because the number of foreclosures in the county is virtually zero. And therefore, you say, are they moving to Nevada? Are they moving to Arizona? That's not what the demographics are telling us. They're just moving.
So there's not the great exodus that they say that there is?
Nope, there really isn't. It just hasn't been that way. When you look at the Allied van lines and their other surveys that show intra-metropolitan area moving, you don't see a large disparity between moving out and moving in. The real heart of the matter is we have great jobs. And if you're in biology or in research or in software, you're not moving to Tucson or El Paso. You want to be not only where the good jobs are, but where there are opportunities to move up to yet another rung on the income stream. So, the college educated workforce isn't leaving California.
All right, Paris, we have about 3 more minutes. What questions do we have left from the audience?
We have 3 more questions left.
Okay.
So one question is, jumping back to our question on the split roll tax, it asks how will it affect the 4 sectors of commercial real estate, and if Alan can give just a brief analysis of each of these sectors.
Wow.
It's a lot to ask in 3 minutes, I understand.
Yeah, I know. The answer is I really don't see a lot happening in any of the 4 sectors.
So keeping
Okay.
everything will be steady and as projected,
Yes.
right? And what do you think is the future of the electrical infrastructure to improve this rolling blackouts that's been happening recently going forward?
Wow. I'm not sure. I'm not sure I'm qualified to answer that. I think I'm going to lay off that question.
All right, let's get one more because we don't want to stump
Yeah.
the speaker with that final question on the infrastructure. So, I saw one in here earlier, and maybe we'll close out with this one, if I may, Paris. And essentially it was, what are your thoughts on the real estate economy, the big picture for San Diego MSA going forward, Alan?
Well, I've sort of played my hand already, but the reality is I remain perpetually optimistic because we have not, and we will not overbuild, mainly because we don't have the room left to overbuild in the urban corridors. So I just see a very nice, smooth continuation of what's going on the last few years. And that's good for everybody.
Perfect. And with that, I am going to share my screen to the final slide that was on your deck. I love this quote by Thomas Jefferson, and it goes in line with your outlook. I like the dreams of the future better than the history of the past.
That is so true.
Wonderful. Well, Alan, Nevin, we are so grateful for you to be here. Again, if you have not picked up a copy on Amazon of Alan's book, The Great Divide, The True Story of America Tomorrow, take a look. It is a fantastic read. Again, Alan is our local economist, our luminary, as I like to refer to him. So Alan, thank you so much for spending the time with us today and the CCIM chapter here in San Diego. We are very, very grateful as always.
Thank you for inviting me.
Wonderful. We hope to have you back maybe first